The structural demand for 24/7 carbon-free baseload power has undergone a seismic shift, moving from a secondary environmental policy preference to a fundamental requirement for the very survival of the artificial intelligence sector. To understand this as a professional investor, we must look past the software and view modern data centers not merely as server warehouses, but as high-capacity industrial furnaces. These facilities require a constant, unwavering stream of electrons to maintain the thermal and computational stability required for large language model training and real-time inference. Because these workloads are computationally intensive and operate at near total utilization around the clock, they cannot rely on the intermittent nature of solar or wind. The physics of the grid dictates that wind and solar, which fluctuate based on weather patterns and the diurnal cycle, require massive, expensive battery storage to simulate baseload characteristics. This creates an immediate, structural necessity for nuclear energy, the only carbon-free power source capable of providing a dispatchable, high-capacity factor solution that frequently exceeds 90%. For the serious investor, navigating this nuclear renaissance requires what we call a filtering logic. In a sector prone to hype, this approach intentionally ignores speculative microcaps and unproven technologies in favor of Tier 1 assets with proven cash flows and vertically integrated supply chains. This elimination protocol prioritizes structural winners, companies that already possess the requisite regulatory approvals, NRC licensed sites, and physical infrastructure to meet today's demand over the so-called PowerPoint reactors. These are companies relying on theoretical small modular reactor designs that, while promising, may not see commercial deployment at scale for a decade or more. We are looking for the industrial backbone of the AI revolution, not its venture stage experiments. Constellation Energy, trading under ticker CEG, serves as the primary fleet operator in this framework. The company manages the largest nuclear fleet in the United States, maintaining industry-leading capacity factors between 92 and 94%. To appreciate the magnitude of this operational excellence, consider the delta in energy density and reliability. While a premier solar installation might only produce its rated capacity 25% of the time due to environmental variables, Constellation's assets are effectively always on. This creates a formidable competitive moat built on the scarcity of licensed nuclear sites. Because the regulatory and capital hurdles for building a brand new nuclear plant from scratch are so high, often taking over a decade and billions in interest, it is far more capital efficient for Constellation to uprate existing plants. This involves increasing power output through hardware upgrades to turbines and cooling systems, or more dramatically, restarting mothballed reactors like the Crane Clean Energy Center. These strategies allow Constellation to bring new megawatts to market faster and cheaper than any competitor attempting greenfield construction. Financially, this operational efficiency translates to robust unit economics and highly predictable growth trajectories. Constellation has projected free cash flow of approximately $8.4 billion for the 2026 to 2027 period. Looking further out, as their contract repricing and capacity expansions take hold, they expect this to scale significantly to a range of $11.5 to $13 billion by 2028 and 2029. This capital is being systematically allocated toward two main pillars of shareholder value: aggressive share buybacks and premium power purchase agreements, or PPAs. By signing long-term deals with tech hyperscalers like Microsoft, Constellation is effectively pivoting from a regulated utility model to a high-margin infrastructure provider. These tech giants are willing to pay a reliability premium for carbon-free baseload power because the cost of power is a fraction of their total capex, yet the availability of that power is the single point of failure for their AI ambitions. However, a sophisticated analysis must include the bear case, which is primarily rooted in regulatory and execution risk. The current valuation of CEG is buoyed by the production tax credit, a key component of the Inflation Reduction Act, which provides a price floor for nuclear generation. Any political reversal or legislative shift that erodes these credits could immediately impact the valuation premium CEG currently enjoys.
Furthermore, while the tailwinds for nuclear are increasingly bipartisan, the sector remains sensitive to operational outages. Nuclear plants are massive, complex machines. A prolonged, unplanned shutdown at a major facility would not only impact immediate revenue, but would also threaten the capacity factor premium that justifies CEG's current market positioning. In summary, Constellation acts as a de-risked cash engine, leveraging irreplaceable scale and operational mastery to meet the immediate, non-negotiable power needs of the industrial AI revolution.
While Constellation manages the conversion of energy into revenue, the entire nuclear flywheel remains tethered to a singular upstream choke point, the uranium supply chain. This is the domain of Cameco, trading as CCJ, which asserts a dominant, near oligopolistic influence over the Western fuel cycle. As one of the world's largest pure-play uranium producers, Cameco's competitive advantage is anchored in its ownership of Tier 1 low-cost assets, specifically the McArthur River and Cigar Lake mines in Canada. These are not merely mines, they are the highest-grade uranium deposits on the planet, allowing Cameco to maintain healthy margins even during periods of suppressed commodity pricing. However, their strategy has evolved beyond simple extraction. Through their strategic 49% acquisition of Westinghouse, Cameco has successfully vertically integrated. They now capture value across the entire fuel cycle, from the raw U3O8 ore in the ground to the conversion and enrichment services, and finally, to the precision-engineered fuel assemblies required by the reactors we discussed in the previous section. For the disciplined investor, Cameco's financial profile is defined by a preference for stability over speculation. They utilize a long-term contracting strategy that intentionally limits their exposure to the volatile spot market. By locking in floor and ceiling prices years in advance, they provide the price certainty that utility customers crave and that institutional investors require for valuation modeling. Their 2025 financial results validate this approach, posting an adjusted EBITDA of approximately $1.9 billion and an operating cash flow of $1.4 billion. This capital strength is reinforced by a fortress balance sheet with low leverage and significant liquidity, which serves as a critical buffer against the cyclical nature of the commodity markets. Yet a sophisticated bull case must be balanced by a sober analysis of the risks. The bear case for Cameco usually centers on three variables: an unexpected influx of secondary supply from decommissioned military-grade materials, aggressive production increases from state-controlled entities like Kazakhstan's Kazatomprom, or the permitting trap. This last risk is particularly relevant. Even with high demand, geopolitical instability or shifting regulatory frameworks can delay new mining capacity for years, creating a tail risk where production targets are missed despite favorable market conditions. Directly supporting both the fuel and generation sectors is BWXT Technologies, which occupies the indispensable picks and shovels position in the nuclear ecosystem. While other firms design reactors, BWXT is the company that actually builds them. They specialize in the complex manufacturing of nuclear components, pressure vessels, steam generators, and reactor cores that require a level of metallurgical precision and regulatory certification that few other firms globally can replicate. BWXT has spent decades as the sole manufacturer of nuclear propulsion systems for the U.S. Navy's submarine and aircraft carrier fleets. They are now translating that high-spec expertise into the commercial small modular reactor, or SMR market. This transition creates an exceptionally wide competitive moat. In this sector, the barrier to entry isn't just capital, it is time and trust. BWXT operates within a regulatory moat defined by decades-long qualification cycles and the highly specialized infrastructure required to handle and secure nuclear-grade materials. Their revenue growth is characterized by high visibility, driven by long-duration government defense contracts and recurring maintenance for the existing commercial fleet. This offers a level of industrial stability and earnings quality that speculative, pre-revenue reactor startups simply cannot offer. The primary risk for BWXT is concentration, because a significant portion of their backlog is tied to naval defense spending. Any major shift in the U.S. Department of Defense priorities or unforeseen bottlenecks in the global industrial supply chain could delay their commercial SMR pivot. When we synthesize these three distinct assets, Constellation, Cameco, and BWXT, into a cohesive portfolio, we arrive at a comprehensive architectural strategy for the nuclear renaissance. In this model, Constellation Energy serves as the core anchor. It provides the stable, de-risked cash flow generated by existing, irreplaceable infrastructure. Cameco acts as the high-beta tactical satellite. Its stock price offers significant upside leverage to uranium supply tightness, functioning as the growth engine during periods of rising commodity prices. Finally, BWXT functions as the steady industrial compounder, capturing the manufacturing value of the sector's long-term physical expansion. This three-pronged allocation covers the entire value chain: generation, fuel, and specialized components. This positioning allows an investor to capture the structural tailwinds of the AI-driven energy demand while mitigating the specific regulatory, commodity, and lead time risks inherent in this high-stakes industrial sector. Together, they represent a complete expression of the nuclear investment thesis: reliability, scarcity, and specialized expertise.